Hi, I'm Tina Colson with Equity Advantage, and I'm thrilled to be here today with Lon Dufek, Senior Manager of the Office of Gift Planning with Providence Foundations of Oregon. And when our clients are ready to sell their properties and retire, they're always hit with this heavy capital gains tax. The good news is we have a variety of options and end games to offer those clients to help mitigate the tax consequences. We've brought Lon in today because he is a well-known expert in the planned giving arena of Charitable Remainder Trusts, CRTs as we'll call them today, and it's an excellent strategy for our investors for, again, that end game piece. So Lon, CRTs are so technical. Can you briefly tell us about yourself and what led you to working with the CRT in your field?
Well, I graduated from college way back in 1976, over 40 years ago now. And before my graduation, I began to work as an intern at a charitable foundation in Arizona, in Phoenix. And I was hired full-time immediately out of school, and I've became acquainted with CRTs as far as I was responsible for the accounting of the CRTs, the administration, and also the filing of the tax returns. And then during the time I was there for about 13 plus years, I began sharing CRTs with some of our supporters who held real estate, and they were very impressed by the benefits. And so we'll talk about the benefits of a CRT here in a second, but there are very nice benefits of CRTs as far as charitable planning is concerned.
Great, and so that just leads me into the next question is what is the benefit to our investors when using a CRT as an exit strategy?
Well, if you look at real estate investors, typically they have held their property for a number of years, and so that property has appreciated over a long period of time, and so due to the depreciated cost basis, there's a large capital gain involved in those assets. And so they're typically involved in a situation where they come to me and say, you know, I really don't want to pay this capital gain tax when I sell the property. Is there some methodology that I can sell it and avoid that tax? And I say, well, let me talk to you about a CRT, which basically has three major benefits. The first is that you're able to bypass the capital gain tax. The second is that you're able to receive income for typically lifetimes, and that income is typically more than the net rental income than you were receiving before. And then the last major benefit is the charitable deduction. So I like to emphasize that there are three major benefits of a charitable trust, and I like to say they're BIC. The B stands for bypass capital gains, the I stands for increased income, and the C stands for charitable deduction.
Excellent. So let's talk about that. And can you give an example of how the BIC would come into play on the sale of property?
Yeah, sure. Be glad to. Let's take an example where you have a couple age 70. They're looking at exiting out of some of their properties, and say that they have a rental home that's worth $500,000, and their cost basis, let's say it's $100,000. So if they were to go to sell that property, they would incur a capital gain of $400,000. And if you look at the capital gain rate, state and federal combined, you're typically looking at about 30 to 33%. And so they would actually pay a capital gain of $120,000. So I like to say to people, well, do you want to benefit the IRS or do you want to benefit your favorite charity with that tax? And I had one gentleman say, well, that's a no-brainer. I would be glad to send that tax to my favorite charity. Good. And so looking at this example, what a person does, or in this case a couple, what they would do is they choose a payout rate. And a payout rate on a CRT has to be at least 5% or above. And so let's assume that they choose a payout rate of 5%. So they would receive about $25,000 per year, that $500,000 times 5% for the rest of their lives. And then they also receive a very nice income stream, and that $25,000, as I explained before, is typically more than a net rental income than they were receiving previously. And then they also receive a nice charitable deduction as well, and the charitable deduction in this case is about $203,000. So not only do they get a bypass of the capital gain, but they get some substantial income tax savings as well. So if they're in about a 35% tax bracket, that actual income savings is about $70,000. So let's get back to the BIC. First of all, in this case, they bypass the capital gain tax of $120,000. The I is increased income to $25,000 per year, and that will vary on a year-by-year basis. And then the C is your charitable deduction, which is about $203,000. So very, very nice benefits, as you can see.
Absolutely, that's great. And I know, so there are different types of CRTs that I'm aware of. Can you give us a brief overview of the different
Sure.
CRTs? Which is the most widely used and why?
Okay, there are actually two major types, and there's some subtypes as well. I won't get into the subtypes, but the two main types are the Charitable Remainder Annuity Trust. We sometimes call that a CRT, and that provides for a fixed income over the term of the trust. And annuity by definition is typically a fixed income stream. And then the other one is a Charitable Remainder Unit Trust, sometimes called a CRT, and that provides for variable income. On each January 1st, the trust is valued, and whatever the value is multiplied times the trust payout percentage. So those are the two major types, and as I said, there's some subtypes of unit trusts as well, but for our discussion, just look at CRTs and CRUTs.
Okay, that's great. And so with this, are there any limitations to the type of property that can be used to fund the trust?
Yes. First of all, the most important aspect of a property that we look at is that it needs to be free and clear or unencumbered.
Okay.
No mortgage on the property, because according to IRS regulations, you cannot put an encumbered asset into a charitable trust. But all types of property can be used. It can be commercial property, it could be warehouses, apartment buildings, office buildings in which we're sitting right now. I've done residential rental property, I've done vacant land. Even in the case of LLCs, you can put an LLC interest into a CRT as well. And so what's nice about a CRT too is that suppose that a real estate investor has a property worth $1 million and they're thinking, I don't really want to put the full $1 million into the CRT. And so I say, well, you can do an undivided interest. Say that you want to do an undivided interest of 50% into the CRT and retain 50%. So when the property sells, the investor receives $500,000, and then $500,000 is used to fund the CRT. And that can work out extremely well because the capital gain tax that he owes on the portion that he kept, the 50%, is typically offset. The tax on that portion is offset by the charitable tax deduction. So most of the time, because of the BIC benefits, charitable trusts, CRTs, are funded with appreciated property, so they take advantage of that benefit. You can also put other types of property, like tangible personal property, into a CRT, like antiques, or I've even seen vintage autos being put into a CRT. That works extremely well. The tax benefits are very complex in that case, but that can be done as well.
There was a beautiful time when we were able to use personal property, such as vintage autos, within the 1031 exchange world, but that has all changed these days. It's all real property. So, okay, we've got an investor. He's looking for that endgame exit strategy. They decide to go with the CRT after talking with you, and they've gotten their illustration. I guess my question would be, at what point within their decision process, should they reach out to you, or is there a time limit where they can no longer do a CRT as an option?
Yes, there is. That's a very good question, and I've had people come to me and say, I heard about the CRT idea, but my property is in escrow. Will that work? And the answer is no. The property needs to be put into the trust before there's a purchase contract signed. Basically, the rules state that you cannot have a designated buyer and a designated sales price prior to creating the Charitable Remainder Trust. And so it's important, to put the property into the trust, to establish the trust, put the property in prior to listing the property. That's the best. That's the best time period in order to set up a CRT. Put it in before, because if you put it in and you have a sale, you have a purchase contract, the IRS looks at that as a completed sale, which means that the investor would be subject to the capital gain tax, which would not be a good result in this case. And so prearranged sales, are not good. You need to do it before. So I would always encourage people to set up a CRT, transfer the property into the CRT prior to listing the property.
Great, and because these are such a technical vehicle as well, I'm sure that you have many conversations with clients prior to everybody
Yes,
just
that's
saying,
true.
this is what
That's
I want to
true.
do, I'm ready to step in.
Mm-hmm.
Gotcha. So one of the things that I also think about is the beneficiaries, and many people, especially when you get into a charitable situation, the children may object, or is there any option with the CRT to make sure that the children can also benefit from the CRT moving forward with the payouts that are coming from that?
Yeah, one of the main concerns in setting up a CRT is you're basically disinheriting a family with that property. And so let me answer the question this way. Let's look at the terms of a trust. A CRT can be set up for a lifetime or lifetimes or multiple lifetimes. It can be set up for a set term of years, up to 20 years. It can be set up for lifetimes plus a term of years, up to 20 years. So what I've seen with parents is that they say, okay, I want to set up a CRT for our lifetimes, say it's mom and dad, plus a term of years for the children. And so to take $1 million trust, once again, if a investor sets up $1 million trust and they say, hey, I want my children to eventually receive $1 million in income from this trust, then you could set it up for mom and dad's lifetime plus a 15-year period. And just based upon projections, you will see that those children will eventually receive $1 million in income. So basically, they replace the asset that way. And sometimes that works out really well because some parents don't want to give $1 million to their kids in one lump sum because they might just spend it. Whereas if you give them income over a period of time, they like that planning strategy.
Yes, I would like to know how many of you know children that would spend the money right away. So one of the other thoughts that I had is with the charities involved, and again, the technical vehicle of a CRT, do all charities accept a CRT within their organization?
Sure, most charities have gift planning officers like myself, but some don't. But all charities would be more than happy to talk with you about a CRT because ultimately the asset's going to go to that particular charity or charities. And so all charities will talk to you about that. But when you talk about the CRT process, if you will, and looking at the steps of a real estate funded CRT, it's actually quite complex. And so you want a knowledgeable and experienced gift planning officer that can walk you through that process. Great. Because what you have is you're looking at the drafting of a trust agreement by an attorney. You're typically working with a title company to transfer the property into the CRT. Then you have a realtor or a broker that's going to sell the property. And then ultimately you're going to sell the property. The proceeds are going to be reinvested by the trustee. And the trust is going to last for a very long period of time. Eventually, the asset's going to go to a charity down the way. So it's important to work with an experienced plan giving officer or gift planning officer that knows how to do this and what the process is so that they can walk them through it and work with the professional advisors, provide projections and illustrations and those kinds of things as well. Right. So that all their questions are answered so that they can make an informed decision up front.
And so now with Providence, I know that you can run illustrations, you don't charge for your consultation, and again, that's all free of charge to the client should they need some information from you up front to learn more about the CRT process. Yeah,
right, that is correct.
Okay.
And, I'm a CPA and CFP by background, and so I've worked with a number of CPAs and attorneys as well in walking through projections, and I give them the charitable tax deduction calculation so that they can run their tax projections as well. So it's very important that I work, directly with their advisors so that we're all on the same page when that decision is ultimately made.
That's great. Are there any other final thoughts that you would like to share with us today?
Yeah, one of the things that I emphasize when I'm talking about charitable trusts in that there are basically three methods to sell property. You can sell property, first of all, outright and pay the capital gain tax. Two, you can use a like-kind exchange, which is a great vehicle to use, a like-kind or 1031 exchange. And then the third is the CRT. but the CRT is not very popular or understood. In fact, most brokers and a number of CPAs and attorneys have not worked with CRTs, and so therefore when an investor has a piece of property, they go to their advisor and they ask them, okay, I'm going to sell this property, and they said, well, you have two alternatives. You can sell it and pay the tax or do the like-kind exchange. Well, we can always add that third option and look at that option and see if that may benefit the individual as well. And because when you look at these BIC benefits, bypass the gain, increased income, and charitable deduction, people look at that and say, wow, that is really a nice method to sell my property. And so the last thing that I would say is that I really believe in the essence of CRT planning primarily because you're benefiting charity. And so you get to choose your charity or charities. You can name one charity or you can name a number of charities. I have a number of CRTs that have 5 or 6 charities that will ultimately receive those assets. And so what's nice about this is that it's a win-win for everybody. It's a win-win for the person because they have the nice benefits with the CRT. It's a win-win for the charity as well because ultimately they're going to receive a very nice gift. And so I always emphasize the charitable intent behind this as well because that's very important. The economics are wonderful with the BIC benefits, but the actual making of a gift is a feel-good sort of situation that the investor really likes.
That's the priceless part.
Yeah, right. That's the priceless part. I work with a donor that they had never heard of this before, and they had 2 duplexes. And when I walked through the illustration, I go, well, would you like to do this? And he says, certainly, because I'm not only benefiting myself and my wife and not paying this huge capital gain tax, but I'm benefiting my favorite charity as well.
Yes, I love that. And great advice from the expert. Lon, you are a wealth of knowledge. I'm so glad that you came in for our Ask the Expert segment today with me. And again, I'm Tina Colson with Equity Advantage, our special guest, Lon Dufek from Providence Foundations of Oregon. And if you are an investor looking for an exit strategy, obviously this is just one more great option for you to choose from that not only will you get a lifetime income, but also that charitable deduction, and you can leave a legacy with your favorite charity. So if you would like more information on this, please reach out to us. Again, our number, 503-635-1031, or you can go to our website at 1031exchange.com. Again, thank you, Lon.
Well, thank you. My pleasure.